Welcome to the Stock Play of the Day. Today's stock is Exxon Mobil, symbol is XOM. We'll discuss, should we pass or should we play? Hello everyone, I'm Brian Overby, Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
Well, Lindsey, I have a chart of the S&P 500 index up, and I got to admit, it's hard to look at. What are you seeing in the markets?
Yeah, I mean, it's not pretty across the board, really, in the markets today. Another big down day this morning. We're off the lows from earlier this morning and last night. The S&P 500 actually triggered, well, all markets triggered the market-wide circuit breaker as soon as the markets opened, basically, whereby because the markets were declining 7%, the market was halted for 15 minutes. We have been trading continuously since that 15-minute halt. It's a reminder of kind of what we saw last Monday, Brian. And in fact, this is the third time in the past week that the circuit breakers have went into effect. So again, that's because the markets have been extremely volatile, really in response to an extremely uncertain situation regarding the impact coronavirus is going to have on our economy domestically as well as globally, but also the moves that we're seeing in the oil market. And you don't see the financial media talking about that as much, but oil has slid significantly. I'm going to get into that in a little bit, but right now keep on track with the market. What else is driving the market this morning? Well, Sunday night, the Fed really shot a bazooka. They announced plans to cut interest rates by 100 basis points to nearly zero, a range of 0 to 0.25%. This is now the second time we've seen that rate since the Fed began announcing rate decisions. So the last time we were in the middle of the financial crisis. In addition to cutting rates so significantly, they also announced $700 billion worth of bond buying activity to help increase liquidity in the credit markets. They're also doing a couple of other things to make sure the dollar remains stable, working with other central banks around the world. They're throwing everything they've got at this situation because what they have seen over the course of the last 2 weeks is a tightening in credit markets, and they want to make sure that our markets are operating as seamlessly as possible throughout this difficult time. So the Fed's doing their part. Many market participants look at these actions and say, look, that's not going to address the slowdown that we're expected to see in economic activity related to the coronavirus. But from their perspective, again, it's all about liquidity and keeping the markets functioning. So they're doing their part there. The other thing that came out over the course of the last 24 hours is some more negative economic data out of China, who has just recently started sending workers back to work. And we got industrial production this morning, well, late last night, and it declined by 13%, more than 13% for the month of March. And that is the first negative reading for that economic reading in the history, the 22-year history of that index. Also here we got some weak manufacturing data out of the Empire. The Empire State Manufacturing Index also declined for the first time in its the largest decline in its 19-year history. So the manufacturing sector is certainly feeling it. You're seeing that response in stocks. The industrial stocks are one of the hardest hit sectors in the S&P 500, also financials and energy. Again, energy, that's why we're gonna take a look at it too. But so we're seeing just really a lot of red across the board while investors look for clarity. Brian, also the VIX, it's something you and I look at every week here on the Stock Play of the Day, and it's jumping higher. The last level I saw was at about 78, up 35% on the day. I mean, what is this telling you?
So when we looked at the VIX, and we actually highlighted this on the stock play of the day, we mentioned the fact that the VIX at that point in time when we were talking about it, the S&P 500 index hadn't made a breakdown below the October lows. We were kind of highlighting that point. And if I show it on the chart, right now I have my crosshairs right at that area where the VIX was actually trading below the 50% level. And we mentioned that if at that 50% level, there's only been I think it was 4 times since the 2008 financial crisis that we actually even came close and touched that level. And every time that we did, we had a pullback in the VIX, which meant that we had an increase in the market because they have an inverse relationship. And we actually mentioned that on this day, that the market actually broke down below that October low, and we had the VIX break up above that 50% level. And that being said, there's no hold bar then on the volatility. At that point in time, you're not saying, okay, we've had this breakthrough of the 50% level, we've closed above that level, now where's volatility going next? And the path of least resistance actually in those type of scenarios is a lot of time to the higher point, as opposed to being a level of resistance and you expect volatility to come back down, get some capitulation in the marketplace. So we did see the VIX go higher. And so what level can we compare it to now? Well, you got to go back to 2008, 2009, when we had the financial crisis. And the VIX actually, the way that it's computed right now, because they have changed the formula for the VIX at some point in time, but the way it's computed right now, you're looking at all-time highs all the way up towards the 100% level as far as the fear index is concerned. So the only thing that we can compare it to is that. And that kind of makes us a little bit scared overall. And also on our graph, a lot of these lines that we've drawn, we haven't even had to adjust at all. In the S&P 500 index, we actually go all the way back to the 2009 level. And I'm going to move my crosshairs all the way down to the bottom of the chart. Right now, we're talking about the 2009 level. And if you can draw this line in at a few different ways. You got one touch here. You might be able to draw it right through here. But we're coming close to the start of the bull market. If you really think that after the financial crisis in March of 2009, that was the start of the bull market per se, we actually even haven't came down to that trend line yet. So that level right there in the S&P 500 index, if I just put my crosshairs on, it's not an exact science. We're going to call it 2,400. Right around in that level is a potential number before we see some more support in the S&P 500 index. And so far it's been touching these levels and doing a little bounce, almost doing a little dance, and then deciding to go back and go lower again. So who knows exactly where we're going to end up at, but I just always want to pay attention to some of these levels. You hope for a bounce and you hope to get some support and some protection from the marketplace just from looking at the charts. And lastly, if we look at the NASDAQ has been looking kind of pretty, and I say that with quotation marks, mainly because it's actually held up much better than the Russell for sure, which has been the worst performing index, and the S&P 500, but we actually had to break down today. We were right at the 200 level, the 200-day moving average, as you see highlighted on my chart right now. That was a big level. It's really added some support in the NASDAQ, and now we just had the big breakdown. Going to the October low, because it didn't even come close to that in the first initial move, well, it blew through that number, and now if there's any level at all, right around the 7,000 level, I guess that's a little bit in June of what was that, June of 2019. Yeah, we got a little bit of support right around this 7,000 level, but then we're going all the way back here to the December of 2018 before we even see any range of where the chart might give us some support overall. All right, so with all that said, let's talk a little bit about oil prices. I'm going to show the chart of the USO, which is an ETF that tracks oil prices futures contracts, the 1-month contract, but oil prices.
Yeah, definitely USO is one way you can track oil prices, or if you have access to different different programs, you can check out WTI. A lot of the financial news sites will quote that. So oil prices are down 50% on a year-to-date basis, and that's a pretty big move in 2.5 months, right? This morning they were below $30 a barrel from a WTI perspective. if we can hover around, I think it's been hovering around at $30 more recently today. But and regardless, it's a big drop. And what's happened was on March 6th, you had OPEC meet with, so Saudi Arabia leads OPEC, met with Russia to discuss production cuts in oil to help support oil prices. They couldn't come to an agreement. Russia just backed out of the deal. And so a couple days later, what did Saudi Aramco do? They cut oil prices to some of the countries that they export to. So further putting pressure on oil prices. Russia's just sitting it out right now. Obviously, this is negatively impacting energy companies here in the U.S. Because energy companies here in the U.S. need an oil price of between $40 and $50 a barrel to really operate at a profitable level. Some more, some less, depending on what company you're looking at. So it's been a pretty stressful situation in the oil patch. It's also been a key driver of market action. Again, I said earlier, the financial media has really focused on coronavirus, and it's certainly impacting all of us in our everyday lives. With different, cities shutting down restaurants and different self-imposed quarantines, work from home situations. This is also impacting the demand for oil. So even though oil prices are lower, you usually hear, hey, this benefits the consumer. But if the consumer isn't traveling, isn't driving around, the demand for oil is going to be much lower. So when you think about the oil complex in general, right now it's being hit with a supply and a demand side issue. So supply is being increased. Saudi Arabia also increasing their supply, even though they're cutting rates. You have the U.S. that's flush with oil supply. And then on the demand side, we're coming to a grinding halt across the globe in fear of the coronavirus. So the demand side is being hit significantly, and it's just a really difficult position to be in if you're an energy company or you work in the oil patch. So it's something that we've got our eye on for sure. In addition to oil being down 50% on a year-to-date basis, we also have the energy sector from the S&P 500 down 50%. And then as our stock play of the day, we're taking a look at Exxon Mobil. That is also down about more than 50% on a year-to-date basis. Exxon Mobil is actually trading at levels that we haven't seen in about 18 years. You have to go back to 2002 to get to these price levels on the on Exxon Mobil, XOM. In fact, the price is so low that its dividend yield is now 10%. So that's a huge dividend yield for an energy company and for really any company in the index. The S&P 500 yields a dividend of about 2%, just under 2%. The energy sector was about 3% before we've gotten ourselves into this situation. But ExxonMobil at 10%, it's a big outlier right now. Now the question is, when you think about Exxon, is that dividend safe right now? Because a lot of oil companies across the board are starting to think about how to rein in costs. So they need to cut their CapEx. And we've heard several companies announce that over the course of the past week or so, Occidental being one, Marathon Oil Company, Diamondback Energy, Apache. These guys are all cutting their CapEx, cutting their spending. And the question remains, who's going to be the first company to cut their dividend? Exxon, it is said, analysts on the street are talking that this is a company that needs $50 a barrel in oil to really operate profitably. So they're worried that Exxon could cut dividends, but I don't think they're on the top of the list of companies that will cut dividends. Occidental Petroleum, I think for most energy analysts, would top that list from what I've seen. And that's because they have a significant debt load after they bought Anadarko Petroleum last year. So Occidental is in a little bit more difficult situation. The other benefit to ExxonMobil too is that they're an integrated energy company. So they do everything across the oil spectrum, from upstream to refining to downstream. They do it all, and they are one of the biggest companies out there, only to be really rivaled with Chevron, which Again, that's another stock that's been hit significantly, down 40% on a year-to-date basis. Its dividend yields up at 7% too. So you just see that these have been beaten up so significantly that you do have to begin to wonder at this point in time, is there some value here? While electronic vehicles and green energy are hot topics, and climate change, of course, are top of mind for everybody from the government to consumers, to these oil companies in general. We are still several years away from being, reducing the need for energy. And since these are the big guys in the room, you have to wonder if now might be a time to find some opportunity. The risk is that there could still be more downside in these stocks and in the sector and in oil prices. You got to watch oil prices, because these companies' earnings are nearly perfectly correlated to the price of oil. So if you don't have oil prices above $30, above $40, above $50 a barrel, it's going to be really difficult for these guys to be profitable. So that's something we'll be watching. But that's why this is a stock play of the day, and we focus on options, because you can find opportunities in short-term plays. Maybe since we're getting to such a low level, you might see a bounce, but after that bounce, the stock could continue to fall further if oil prices continue to fall further, or maybe this is the bottom. We don't know. We're not here to time markets, but we are here to help you find some opportunities and to learn about different sectors and industries and companies. So that's what Brian and I love doing the most. So with that, Brian, from an options perspective, what kind of opportunities do you see in ExxonMobil, given the uncertainty that does remain around the oil patch?
Well, yeah, I guess if we were to have an alternative title to the show, we could say Catching Falling Knives. Ideally, a lot of people.
That, Brian.
I do too. A lot of people are looking at when can I get into the marketplace, and a strategy where you can go out and try to find some knives that have maybe been dulled a little bit from the big downward movement is actually a cash secured put. So if I look at the chart right now, I'm going to highlight some of the numbers that Lindsey actually mentioned. If we see here, you can kind of see my cursor in the lower right-hand corner of the screen. If you go all the way back, this is 2000. Look at this area where, it's been a long time since ExxonMobil has been down to this level. Because of the drop, it's increased the volatility, and that spike in implied volatility means that if you're selling option contracts, you're receiving much more than you were before the big downturn in the underlying stock. So if you're trying to bottom fish, one strategy that you can do is just put limit orders in below where the current market's at. Say, for example, Exxon right now is trading at $36. You say, well, all right, I'm a little nervous about oil, but how much lower can it go in Exxon, right? When can I get in? And there's also a FOMO situation here, right? Fear of missing out, that if I wait too long, when the bounce comes back, it's going to be extremely fearsome to the upside and have that V-shape type recovery that everybody's kind of been talking about. So if I'm looking at this, what's the strategy that I can do? The strategy, I'm going to highlight it here inside the Ally Invest Options playbook. It's called a cash secured put. And the difference between a cash secured put versus selling a put outright is that you're saying, I have cash on the sideline and I'm willing to buy the stock. If it comes down to my strike, I'll buy it at that strike price. And by saying that, I actually get paid now for saying I'll buy the stock later if it comes down. And because of the inflated volatility, we're actually getting paid well for saying that we'd be willing to buy more. But as we said with Lindsey, what Lindsey's mentioned, there's really no idea where oil is going to go at. We're at all-time lows in oil. It's been a long time since the price of the crude oil contract has been down around the 30 level. We even jumped down to about 26 the other day. And so when you think about that, you're bottom fishing. I don't think there's any other industry that you can bottom fish more in. Maybe the airlines are something that would be equivalent than the actual oil marketplace right now and where the price of oil is in some of the oil companies. So let's get into the strategy. If I look at ExxonMobil right now, there's the dividend that Lindsey mentioned, 87 cents a quarterly dividend. The ex-dividend date was in February, so we're going to have one coming up soon. And then also, Lindsey, some of the other things to be kind of scared about, earnings. April is going to be the earnings month, and we're not even close to some of these earnings yet. So we don't know quite how quarter one's going to play out as far as earnings are concerned. ExxonMobil is going to be announcing at the end of April. It's down 4% today. $36 is where it's trading at. So my expiration that I'm going to look at, I don't have to go far out in time to find premium. If I go to the April 3rd expiration, which is 18 days away, and I'm going to take my limit order concept here that, gosh, if Exxon would come down to 32 to basically almost all-time low levels in Exxon as far as the chart is concerned, 18-year lows in Exxon. If I'm willing to buy at that level, I can actually get paid right now. We're going to call, well, we got a little bit wide spreads because of the fact that the markets are so volatile. We're going to look at the 32 strike put. So we're looking here at the LI Invest option chains. We've got the quote of the stock up here. On the right-hand side, we have the put options. We have the stock price right here also, and we're highlighting that we're going out 18 days, which is the April 3rd expiration date. And I'm saying that if ExxonMobil comes down to 32, I'd be willing to buy 100 shares at 32, which means I have to have the money to buy that, and hence the name cash secured put. So I'd have to put up $3,200, which is the strike price times 100. That would be the requirement here. And by the way, this is a strategy that if you have options trading approval, you could even do in a retirement account, like an IRA or a Roth account, because all you're saying is that I'm secured by the cash. It's not much different than putting a limit order in, saying if the stock gets to this level, I will buy it. But in this instance, just going out 18 days, going $4 low, below where the market is at, we see that the midpoint of this option contract, and I would work it a little bit. I'm going to work off the midpoint because we've got a little bit of a wide bid-ask spread, and that's, like I said, volatility will widen spreads a little bit, is $1.60. So I'm saying that if I can buy the stock 4 points lower, 10% lower right now, I can bring in about 5% of the actual stock price based off of a $32 buying price. 5% now for saying I'll buy the stock 10% later. Like, these numbers are just kind of crazy to even look at overall, but then the marketplace is hard to even talk about. So if I put this in the right rail, this is actually what our strategy is. Our profit and loss graph is going to have limited and known upside. If I draw this inside our P&L graph here, and let me get rid of the trade over, we'll do the review here so I can zoom in a little bit. So if we're doing this graph, we see this is where the stock is currently at, right around $36. I have it highlighted on the screen. And we're saying if the stock comes down to our level here at $32, we're willing to buy it. We're getting paid now. Now, if I jump over to the profit and loss, to the options playbook, you'll notice that inside the playbook, when I drew this graph, I did a dotted line. And this dotted line is implying that, okay, I'm doing this strategy, and you can say that, well, this is a bullish strategy to start with. But the ideal situation would be if the stock came down, I bought the stock, and then the stock continued on up. And I had a much lower cost basis in the underlying stock. So if you're bottom fishing, and you're looking to maybe buy some of these sectors, you find a stock in a sector that you like. We just picked ExxonMobil. Overall, you could have talked about Chevron. You could have talked about a plethora of different stocks in this level. And just pick the one that you like the best and maybe sell a put on it to get yourself situated that you could buy the stock if it does actually come down lower at this point in time. And some people might even buy the stock and then sell a put to kind of leg in to owning that stock purchase. Like, once again, FOMO, fear of missing out. I don't want to miss out on an opportunity. This is one way that I can bottom fish, by selling cash secured puts. All right, so we're running up against our time limit here a little bit. almost a half hour. So what I need now is to look at the actual trade and do a quick summary here, and then we'll get to your listener questions. If you have any, please write them in the chat box, and we'll try to address them here shortly. But if I'm selling an Exxon Mobil put, this is our actual trade screen. I'm going to try to focus on things that are above my little picture. XOM, it's right now trading at 36.07. We're going to sell to open, and that would be the vernacular used. And April 3rd, about 18 days away, 32 strike put. The midpoint right now is about 165. I'd probably try to sell it around 160. I would try to work the order a little bit. If you do it at the natural, where the current market is at, you're getting $1.40. All of these premiums are amazing considering you're only going out 18 days in time, and you're trying to buy the stock 10% lower. I mean, that is a crazy number as far as the type of premium that we're receiving. So our risk here is that of owning stock. From 32 on down, we're going to have substantial downside because the stock in theory could go all the way down to zero. But then on the upside potential, if the stock continues on up here and it doesn't give us that opportunity to buy it, whatever we bring in would be our net credit to the account, and that would be the maximum we could make on the trade. But then again, if we just put a limit order in saying we wanted to buy it lower, well, our maximum that we can make on the trade is zero, right? You're just saying, I will buy it at that lower price. And that's the outlook on the marketplace. So that is the stock. That is the play of the day. And once again, it's not meant to be a recommendation. We're just trying to learn here, and we're just giving you ideas if you're bottom fishing, right? If you're looking, how can I participate in this marketplace if these things that have already reached what the perceived bottoms in the market can't go any lower? Well, what's a way that I could participate if they do? And cash secured put selling is a great way to approach that. All right, so let's get into your questions before we go to the summary here. All right. First one I'm going to give for you, Lindsey. All right, ready for this? Jay Pullman says, doesn't this also devalue the dollar with oil tanking? I'm assuming I'm going to put in that little stipulation.
Well, I think it's a good question. I think that when you think about the dollar, the way oil prices interact with the dollar really is based on demand. And so if the demand environment, the growth outlook is declining, that's going to impact the dollar, assuming it's declining, the outlook's declining for the U.S. So they're interrelated in that way, but oil prices don't necessarily drive the dollar directly.
All right, Lindsey, you're not off the hook yet. So here we go. Here's the next one. Does the energy sector look attractive from here from a fundamental perspective? Sorry, I butchered that.
Yeah, I mean, it's like we talked about, Brian. A lot of parts of the energy market look very attractive here. I think that you have the oil and gas drilling companies, the sub industry within the S&P 1500 down 70% on a year-to-date basis. Some of the other sub industries are down 50-60%. So these companies have taken a big hit. The concern is their debt levels of debt and the potential for M&A if possible. So it's really difficult, I think, to get fundamentally positive on this sector until we do see a stabilization or improvement in the price of oil. There's a big question mark out there with regards to how long OPEC and Russia are going to allow prices to decline this much or stay this low. For how long are they going to allow them to be this low? And then also on top of that is, again, the demand dynamic. So lots to watch.
Okay, and then I see Jay actually has a follow-up question here. He said, I think he's correcting me in my statement, and is talking about the 700 billion QE, quantitative easing, I guess. Overall, that would drive the dollar down a little bit, which obviously affects oil. And I guess we can talk a little bit about the relationship of the dollar and oil.
Yeah, no, that definitely, you're spot on. The stimulus coming from the Fed, the monetary policy changes that were announced on Sunday as well as last week and the week before does have an impact on the price of the dollar. But the Fed also, as part of their plans, announced that they were going to work with central banks, other central banks across the globe, Bank of Japan, Bank of England, ECB, to open swap agreements to make sure that they are able to stabilize the price of the dollar. And I haven't looked exactly to see what the dollar is doing today. I do think it's remaining pretty stable though. So, but it's a good point. And should the situation deteriorate further, you will see the dollar come under pressure.
All right. Well, we're running up against the time, but I got one question for me. Sari actually asked, would you consider a short put spread in Exxon as an alternative to buying the stock? And the answer is, yeah, this is an alternative. Now, if you weren't interested in buying the stock, obviously inflated volatility has made selling any type of strategy an interesting trade to do. So I don't really want to buy the stock. I would sell maybe the 32 strike put, that same expiration, and buy either the 30 or maybe the 29, depending on what type of credit. Would that be a viable way to do it? Yes. But now you're speculating. You're not saying I want to bottom fish. You're saying I'm hoping that these options expire worthless and I make that net credit. So we're a little bit long, but let's do a quick summary before we get too far there.
Sure.
So let's talk about, we kind of went over this, but market index, Lindsey, you want to just touch on that a little?
Yeah, I mean, it's under pressure. We're uncertain where the bottom is here, but you mentioned some of the key technical levels, 2,400, looking at that 2009 trend line. It would be nice to see us bottom around there in the S&P and hopefully digest some of the information that we get and, eventually be able to move higher.
Yeah, there's nothing to look at. The chart can give us a few, some point where you're hoping that you're going to get some support, and it's provided some support at some of those levels, but it's always made that little dead cat bounce and then came back and broke through those levels to the downside. So that's really kind of been the theme. And then the stock of the day, Exxon Mobil. I'll just give a couple of things about Exxon. If you're tracking oil prices, obviously the best way to do is to go to the Chicago Merc Exchange and look at crude oil there. But if you don't have futures quotes, one of the things that does kind of track is the USO, which we were showing earlier. But I also wanted to mention USL. The USO is a monthly contract. It's an ETF that actually tracks the futures. It actually trades the futures, but on a monthly basis. And it's quoted more often on the financial channels. But the USO, or USL, L as in Larry, if you actually look that up, that's a 12-month futures contract. So a little bit more long-term, and it's worth mentioning. I know a lot of people don't necessarily know that, but if you're going to be trading ExxonMobil, you want to have an easy way to look at what's going on in the prices of the futures contract in oil. And then my option strategy at the very end, yeah, I think this applies to a lot of different stocks at this point in time. If you're bottom fishing, selling puts in a volatile marketplace, saying I'm willing to buy some and then hold it for the long term, it's a viable strategy in this marketplace. Well, that's going to be it for the stock play of the day. Please click subscribe and ring the bell so that you get all of the alerts. And we'll be back same time, same place next week. Anything else, Lindsey?
See you there.
All right.
Just see you there next Monday.
Talk to you soon.